All right, Eel Nerds, episode 119. It's a combination episode. I will start by answering some questions that were asked in comments. Thank you for watching previous episodes. And we're going to play a value Super Bowl, not just a yield Super Bowl, but a value Super Bowl. Couple of quick things. We are up to 297 subscribers. Thank you for your support. If you are joining here for one of your first few times, please remember there is a playlist and you should use that to watch the show in an organized manner. Most importantly, I don't have magical powers. Don't trust me. Make sure you verify what you hear. Couple of quick things in terms of feedback from people who watch it. Chris, thank you for your notation that I did not add chapters. I added them to the wrong place, so I did fix it. So you can jump around now. Thank you, Chris. Today's episode is organized into four parts. First is a recheck of the portfolio. The second, I will answer two specific questions from subscribers. And the third is what I call the Value Super Bowl. We'll look at the best fixed income and equity investments on the value side. Last but not the least, next steps for me, and you do you. Hey, how are the markets doing for you? The last, year to date, kind of see you can see a little bit of an up and down. The last 3 months doesn't even go that much up, and the last month is a little choppy. I don't know how you feel about it. Let me tell you how I feel about it. My year to date is positive. My 3 month is positive. My 1 month is also positive. And there is a simple reason for that. It's because I am sitting out equities for the most part. Less than 0.5% of my portfolio is equities. So the ups and downs in the market lately, a lot of downs don't really bother me. And even within fixed income, a large chunk of what I have is in treasuries. And I used to have an ETF. I got rid of that as well. Mike, thank you for the kick. I didn't really want it. I held on to it because I had some losses and I just sold it. And as far as my fixed income assets, as you can see, the vast majority is in treasuries, agencies, and preferreds. I do have a small corporate bond holding that I'm just going to hold to maturity and a very small, very, very small amount in equities. Well, I mentioned I was going to answer a couple of questions, one of them on preferred stock. And as you can see, I'm trying to figure out what my preference is in cake. So let me get to that question. Wing, thank you for the question. You said, hey, what are the risks on preferred stock? So I'm about to dive deeper. I want to make sure you know that I am not a wealth management advisor. I don't pitch product. I don't have merchandise. I'm sharing my education. You do you. When I try to understand market cycles and preferred stock or any other asset class, I use a certain publication, and I have no financial relationship with Invesco. I just happen to like their annual outlook, and their 2021 has a very simple picture. The picture looks like this. It says, during recovery, which asset classes perform well? How does it work in expansion, slowdown, and contraction? And as you can see, there are very clear winners in each economic cycle. So if you're in an expansion, you want to own equities. If you're in a slowdown, treasuries. If you are in a contraction, treasuries by a mile. And if you're in an recovery, then you go towards high yield bonds. And you can then argue, where are we? And some people may argue we're in the greatest expansion ever, and the last month says otherwise. So I'm going to say in that same picture, we're somewhere in this area. We're slowing down. There isn't an official contraction. Nobody knows where exactly we are. And preferreds, in my opinion, fit in that area because they're neither an equity nor a fixed income instrument. And as you can see, equities go from up to down in this phase. And you got to be careful. A preferred stock at the end of the day has an equity tied behind it. If the equity goes belly up, if the equity goes bankrupt, your preferred stock goes with it. So you got to make sure that if you're picking a preferred stock, you use some discipline. For example, you only want to pick preferred stock that pays more than a treasury. Duh, simple statement. You also don't want to buy convertible preferred stock during this phase because if it converts and the equity has crashed, you are left holding the bag. Not a good idea. And for many reasons, you want to own cumulative preferreds. And lastly, you want to buy below par and hope that even if it gets called, you make a couple of extra bucks. If it, doesn't get called, at least, you have some cushion there. And most importantly, evaluate the underlying equity and make sure that the likelihood of it going from up to a crash is not very high. Do your due diligence. So I'm going to answer this question with my portfolio. I literally own 6 equities, and as I told you, less than 0.5% of my portfolio. And I did have ADM, and a couple of you mentioned in comments, hey, why are you owning ADM? It doesn't look good. You are right. I agree. I dumped it. And I do have 2 preferreds. I don't have a huge chunk in any of these equities, but I do have 2 preferreds. And I was going to dive deeper into each of them so I can explain why I own them. Remember to do your own homework. Now, if you were to research PG&E, which is one of the preferreds, PG&E is the equity I own, the preferred of PG&E called PCGPRB, you will see that all the analysts are increasing their annual price targets. The company itself has beaten their quarterly profit. They are raising their annual stock. So things are coming up for PG&E. Good for them. Same with AMH. AMH has upward revisions. They don't have a lot of debt. They are, in my opinion, a very financially sound home builder. And so here are the reasons why I own those 2. And the opposite of these reasons would be risks. Number 1, if you owned a preferred stock of a company that is not defensive in the current economic cycle, according to my opinion, you would have trouble. And so the 2 preferreds I own are defensive utilities and home building in real estate, which also is good to hold during an inflation. They both are cash flow positive. They make a lot of cash flow per share. They are both cumulative preferred stock, which you want because otherwise they can stiff you on a dividend. They are both trading below par, and they both yield 20% plus above what I could make in a treasury. And if we are officially in a recession or as we head towards it and the signs are very clear, I will sell them and convert it all to treasuries. But for now, I get to make a little bit more yield, and that is why I own them. I hope I answered your question. Let me go to the next question. Hey, what are the difference between the old filters and the new filters? And what do you mean by greedy and not greedy? And to answer that, I am going to play my favorite game. And instead of playing Yield Super Bowl, I'm going to play Value Super Bowl. Where should you park your cash? More importantly, I'm going to share where I'm parking my cash, and you do you. And Value Super Bowl, I'm going to split it into 2 pieces. One is a fixed income Super Bowl, and the other is an equity Super Bowl, both in terms of value. And when it comes to fixed income Super Bowl, I am going to sit here and say there is only one team playing. Look here. They all have the same uniform. The other team is not even playing. And let me explain who that one team that is playing is, in my opinion, and why I say so. Unfortunately, as a country, we are addicted to debt. A good chunk of the world is addicted to debt. And our own Congressional Budget Office, a nonpartisan entity, is saying we're going to be deeper and deeper and deeper into debt. Well, treasuries are the debt that finances the country. If the country needs more cash, they have to pay more for it. So the prospects of a higher interest rate are higher, not lower. So that is one reason why I own treasuries. And if you kind of look around, the fraction or the share of treasuries owned by non-US countries is shrinking, while domestic is increasing. I feel good about being part of the domestic piece of the pie there. And among the foreign holders, Japan is a leading holder. China is vastly decreasing its holding. And there is a very simple reason. China needs the cash, so they are selling it to use it internally. Japan, unfortunately, has a currency problem. Their interest rate is 0.25% or 0.5%. So if you're a Japanese citizen, you can either save for retirement at a clip of 0.5%, or you can put it in US treasuries and save it at 5.5%. So a lot of Japanese money is flowing out, and it's hard for them, and they're trying to figure out what to do. In the meanwhile, you look at who owns domestically. The Fed itself, through quantitative tightening and quantitative easing, buys back some of the money they print. You and I are in the other column. Banks own 10% of treasuries. The reason I'm pointing all of these out is it appears to me that owning a treasury, you are in the company of some big dogs. You don't have to be worried about, is it going to go upside down? What else is going to happen? Is a different country going to take over? All those kinds of risks are not there. We are still a formidable nation. I believe in America. And as long as we manage our money wisely, and there may be some changes needed, I think we'll do fine. Now, let's talk about the great financial crisis and what happened. HQLA means high quality liquid assets. When the great financial crisis happened, there was a big difference between assets and high quality assets. And when there was a run in the bank, people tried to withdraw money. The bank needed to have enough reserves, and if they did not have enough reserves, they had to convert assets into high quality liquid assets. And so the bank had to sell what they already owned at a big loss. And that is what brought down the system to the point where the government had to step in, they had to give stimulus, they had to do all kinds of things to prop up the banking system. Well, looks like the nation has learned the lesson. It's more like they changed the rules, and I'll tell you more about it. These days, every dollar in the bank's reserve counts as high quality liquid. You sit there and go, wait, are you sure? Turns out it is. Let me explain more. The odds of another 2008 style crash is very low. Now, sure enough, there was the Silicon Valley Bank, and there will be this community bank and that community bank. But a large number of banks going under, the odds are low for a very simple reason. When a bank has an underwater investment that they call the held to maturity account, used to be that the bank could not borrow against the red. They could only borrow against the blue. Until the government said, don't worry about it, you can borrow against the red. We will just pretend it is blue. Literally what has happened. So the government set up a facility where you can take the held to maturity bonds that are at a loss and treat them as though they are above ground. And when you change that rule, all of a sudden the FHLB can actually buy those underwater bonds and use them as collateral. So it's a little bit dicey, but at the same time, it's the government that makes the rules. And if those are the rules, then you're good too. And that's why I think, again, coming back to why I own treasuries and I don't worry too much about it. Good or bad, you can argue your point, but the government changes the rules to make sure treasuries are still a vehicle from which they can borrow. But the real problem is that the government makes $1, spends $1.05, and now you have to borrow the 5 cents extra, and you also have to borrow to pay last year's interest on the 5 cents you borrowed last year. And debt as a percentage of GDP, if it is more than 100%, the party doesn't last too long. It starts growing faster and faster. There is also the concept of what's called a primary balance. That is the total revenue of the country minus the expenses of the country without taking into account interest expense. If you lived within your means, this would be net profit for a company. It would technically be EBIT. It's earnings before interest and taxes, although the government doesn't have taxes. And so let's look at how these two are aligned for the world. And this is a Reuters article, a really good one called Bond Markets Face Treasury Tsunami. And here is what this shows. The GDP as a percentage of debt for the United States is crawling higher. After COVID, we had a downward trajectory only because the GDP grew very fast. Debt did not grow as fast. But as GDP growth slows and debt is high, that equation is going north very quickly. You can see what's happening to China. It's terrible. Their GDP is growing slow, but they have such a big debt at a huge interest expense that they are on the wrong path in a hurry. Primary balance. The concept that we need to go borrow to pay interest is a very scary thought, and it looks like every year we are spending 5 more cents on the dollar, and we're going to borrow to pay the interest on that 5 cents on the dollar. And so on the one hand, this is terrible, and I really hope we can come together as a nation and fix it. On the other hand, I also see that as prospects of higher interest rates on treasuries. So unfortunately or fortunately, inflation is most likely here to stay. Inflation will make things we already own more valuable. So if you have a hat that you bought for $5, the hat is now worth $50. Then you go sell the hat that's $50 and you pay off the loans on the borrowings you had for $5 and you go drink a $32 cup of coffee. Sounds unfair? Well, I would tell you, you just sold your hat for a huge profit. So what if you spend on the $32 cup of coffee? All that works out if you own the hat. For your kids and your grandkids, they have to start with zero and now buy a $32 cup of coffee, that is where inflation bites. So at the end of all of this, inflation unfortunately is going to be around, high interest, is going to be around, treasuries are going to be around. If the system is designed to change the rules when there is a problem, I'm going to play by the rules and I will keep betting on treasuries. If there is a big crash in equities, I might go there if I think the moment is right. Inflation is a terrible thing, but at this point, as an investor, I'm going to stick with short-term treasuries and hope the wounded warrior fixes themselves up. Well, that's the fixed income Super Bowl. What about the value equity Super Bowl? Well, this is another question that said, hey, what are all these filters? Get rid of all of those filters for me, simplify it, and bring it down to what really matters. Well, each of these filters look for different things. One looks for dividends, another looks for a 52-week low, another looks for Russell, and so on. And I'm going to review some of those. I want to once again repeat that I am not a wealth management advisor. I don't have any agenda here. I'm sharing my learning. Make your own independent reasoning. And so here are my filters. I run them practically every day, and I look for new companies that show up, or I look for companies that show up on more than one of these filters, which means not only do they have cutoffs in terms of high trading volume, low debt, high profit, low PE. In some of them, I look for return on investment. In others, I look for really high profit margins. And yet other ones, I may look for or low price to cash flow. And if something is able to meet all of the criteria and feature predominantly in all of these filters, those are the ones I start buying or researching more. So that's the difference between all my filters. And I'm happy to email you screenshots of the criteria on Schwab. Feel free to email me, yieldnerd@gmail.com. Having said that, if you were to run, and please do your own homework, if you were to run each of those filters and write down the names of the companies and counted the number of times each company occurred in every one of those filters, you will see that Cal-Maine Foods, TK Tankers, Chord Energy, and Chesapeake appear in more of those filters than anything else. Then you have to say, gee, I wonder what will happen if I ran these four in the value equity Super Bowl, and that's what I'm going to do now. So I'm going to compare TK Tankers, Chord Energy, Cal-Maine Foods, and Chesapeake Energy. And if you only look at stock performance, Cal-Maine takes the cake by a small margin. However, if you were to look, across multiple criteria, and that is what I'm going to do, you can actually see that Chesapeake Energy has dropped in the last 6 months, if anything. So let me run through each of the criteria. And the first is we're looking at volume, and you're going to see that TK actually has the lowest volume. Now, what does that mean? It just means the spread is wider. So you got to be careful when you buy TK. The algorithms may try to guide you towards the high end of the spread. And I'm always very careful to go towards the middle or the lower end of the spread when you buy TK, because the spread is very high. That problem doesn't exist in the others. So that's one thing. TK kind of has a negative point, if you will, on the volume side. And in terms of dividends, Chord is a runaway winner with 5+%. And as a matter of fact, they have a special dividend and a regular dividend coming up. And then you look at, how about profit margin? No contest, TK Tankers has the highest profit margin. They also have the highest return on assets, the highest return on equity, and the highest return on invested capital. And that is across the board. As a matter of fact, if you had nothing better to do, compare TK Tankers with any of your favorite tech stocks. Let me know how it goes. Then let's go to their valuation. And you're going to see Chord Energy has the highest earnings per share, but TK Tankers is half as expensive. And Cal-Maine has a really low price to sales, meaning you could literally take the annual revenue of Cal-Maine and buy all of their stock. That's insane. The price to sales is 30 for tech stocks, just to give you perspective. And cash flow, once again, stunning numbers here. If you took the cash flow alone for TK Tankers and took 3 years of it, you can buy all of their stock. So Cal-Maine is pretty close, maybe marginally ahead. The point in all of this is the lower price to cash flow and lower price to earnings, at least on valuation, seems like TK is a pretty good winner. Then let's go to growth. Look at that. TK's earnings per share grew at 123%. All the others actually declined. So you note that and go, what's going on with TK? Not only that, their actual revenue also grew by a really big number while the rest of them dropped. Then you go to dividend coverage ratio, and you can see plenty of room for TK to increase their dividends. And however, when you come to dividends actually paid, Chord Energy pays a ton of dividends. Now, I personally believe any of these are wonderful stocks to buy. It's just that I'm running a Super Bowl, so I want to pick the best of the best. That's why I'm doing this. Then you go to the gross profit margin, 56% gross profit margin, but TK has such low operating expenses that they are the winner in operating margin and net profit margin by a mile. These are numbers any company would be fortunate to have. Please do your own homework. And then you come to financial strength. And look at this. TK has 4 times the cash needed on their hands, so they can afford anything. And not only that, their return on invested capital is 30%. Guess what your return on invested capital is for treasuries? 5.5%. So the way TK behaves is just stellar. And so at the end of the day, if you go back and look at each criteria and you want to give one Super Bowl winner, if I were the one making the decision, I would give it to TK Tankers. You do you. So what are my next steps? Well, I'm sticking to my knitting. And I did sell SRLN as I told you. I bought Cal-Maine, I bought Chord, and of course I bought TK Tankers because it won the Value Super Bowl, and I did sell ADM. And at the end of the day, my simple note to you is the following. Be very careful when you're trading. I'm going to point out the Schwab feature, if you will. When I try to buy an equity, and let's say I had, $10 in the bank, and I tried to buy an equity that would cost me $36. You can see how Schwab will give me an error saying, hey, you only have $300 in your bank account. You are trying to spend $3,000. You cannot buy it. You do not have enough cash in the bank. Thank you, Schwab, for not letting me spend the money I don't have. Well, here is what I noticed. If you now try to buy a treasury and you only have $300 in your bank account and you try to buy $3,000 of that treasury, magic, that goes through. And Schwab says, by the way, you have negative $2,600 in your account. We will just keep billing you interest on that until you fill the bucket or until the next treasury matures. We know you're going to manage this. Thank you. And I had to call them and say, I don't want to buy anything with money I don't have. And so I finally did get that corrected. If you're on Schwab, you may need to call customer service and say, hey, don't let me buy fixed income with unsettled cash or cash that I don't even have on my account. I would do that. Whether you want to do that or not is up to you. I don't like paying margin. I don't like paying interest. And this is built as a new feature. So watch out. All said and done, even a broken clock is right twice a day. So don't take anything I say as the correct answer. Do your own homework, and thank you for watching Yielder.